From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Monday the 4th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day stateside from London. I'm Guy Johnson, Alix Steel over in New York. Welcome, everybody, to Bloomberg Markets. Alex, energy on a roll. We've got oil prices moving higher, equity markets drifting once again, a little lower. We'll see how this week progresses.
Yeah, it's really a mushy Monday is how I was kind of thinking about it. Thank you, oil, for the highest since we've seen since 2014. Okay, I said mixed, but really it's kind of mushy. So the S&P is down by 0.3%, but no surprise, the S&P Energy Index, the outperformer. Now, after that, you get some of the safety trades, though, kicking in. So it's really hard to develop a theme within the equity market. Helping sentiment a touch is a weaker dollar, down about 0.2% after a really solid few weeks. Sort of putting a little bit of steam rolled out of that. The yield here on the 10-year, you got some buying coming in. Yields down by about 2 basis points. Sorry, you got some selling there, but still 148. We're not even near the high end of the range that we had seen, so a little bit softer there as well. And Guy was talking about it. Brent crude now at 81. I mean, a 7-year high. I just got to say, and that's all because of OPEC in some ways not increasing their production output. At some point, that number is going to really start to bite into the overall equity market, Guy.
Yep, absolutely. We're keeping an eye on D.C. Chuck Schumer saying they may work over the weekend to get this done on the debt ceiling. The data that we were hoping that would be appearing on our screens right now, I can't see. So, perfectly timed. There it is, dropping right on cue. So durable goods coming in bang in line with expectations at 1.8. That's the headline number. The ex-transport number, Alex, a little bit stronger at 0.2. Factory orders, what do you got?
Factory orders rising by about 1.2%. So that's also in line with expectations and better than it was back in July. And July was revised higher as well. So potentially those supply chain issues not yet hurting the factory orders. But the supply chain issues is one story. The dysfunction in D.C. yet quite another. We still don't have a vote on infrastructure. We don't have a deal on the human infrastructure. There's a huge gap in between. And there's still the debt limit that we're counting down to. We're now about 14 days away. We want to get an update now on that with Bloomberg's Anne-Marie Hordern joining us. Anne-Marie?
Well, Alex, you outlined a number of issues right now facing this White House. And today the president will address head-on the debt ceiling to the American people. He'll be giving a speech. We're hearing from Senator Schumer that they may work through the weekend, but this would be the Senate trying to vote through what the House has passed in terms of a suspension of the debt ceiling. The issue is the Republicans promise that they are going to block this. They don't want to have a simple majority, 51 votes for Democrats, to suspend or lift the debt ceiling. They want the Democrats to go via reconciliation. If they do that process, they really need to begin today, because experts say it's about 2 weeks, and Treasury Secretary Janet Yellen already said October 18th is really that X day in terms of when we're getting very, very close or will hit that debt limit. And then, of course, the other issue facing the president, which he addressed Friday at Congress in this closed-door meeting with House Democrats, is trying to bridge that divide between moderates and progressives to get his agenda through. And the gap is about $2 trillion, with Senator Manchin saying he wants something close to $1.5 trillion. The progressives saying they're going to be needed to be a little bit higher at the very least, even if they are able to at least come down at 3.5. And the main takeaway is that the president really gave a nod to the progressives, saying there will not be that hard infrastructure vote until we have at least a framework and agreement on the softer infrastructure package.
Seems odd that they're focusing on the number rather than the policy and what's actually going to change in people's lives as a result of this. Bloomberg's Anne-Marie Hordern, thank you very much indeed, keeping us up to speed with what's happening in D.C. Another factor we need to watch out of Washington is that the U.S. Trade Representative Katherine Tai about to make a speech at the CSIS event where she's expected to lay out China's shortfalls in agreements struck under the former president, Donald Trump. She's expected to meet with the Chinese Vice Premier, Li Hu, pretty soon. Joining us now to talk about this, Scott Landman, to give us a focus here on what we need to know. Scott, let's talk about what is going on here. The administration believes that the Chinese are not living up to their part in that bargain. The Chinese, at this moment, look like they're unlikely to change their positioning. So what comes from the Biden administration next? What are they going to do in terms of dealing with this divergence that we're seeing?
Well, that's what we really don't know at this point, even though the U.S. Trade Representative Catherine Tai is sort of outlining the Biden administration's strategy in the speech today. She said she will speak with Vice Premier Levkovich soon. They will try to enforce the fact that China has not lived up to their commitments in the Phase 1 trade deal, which is something we've known for some time because the numbers have been coming out for a while, and they're well short of expectations or the targets in the deal. But we're still waiting for details on what kind of enforcement the U.S. will try in its strategy. Maybe that's what's going to come, or what is she saving that for the private talks with China that'll come in the coming days?
But the rhetoric is that the heat's going to keep on going. The heat's not coming off. In fact, it might get even hotter. Bloomberg Scott Landman, thank you very much. And all of that really sets the stage for what's happening over in China. Evergrande Group and its property services arm were halted in Hong Kong stock trading. That's amid a report that the developer agreed to sell a controlling stake in the unit to raise much-needed cash. At the same time, we just heard that Chinese developer Fantasia didn't make payments due on 2021 notes. Here with the latest is Damian Sassower of Bloomberg Intelligence. How bad are we doing here?
Yeah, no, I mean, well, you make a great point. Look, the potential deal for a 51% stake in Evergrande overnight came from Hobson Development, another Chinese property development company, the Invisible Magnet, the Chu family, very wealthy. But those bonds are then trading off something on the order of 5 cents to 90 cents on the dollar, which means the market's not really reacting very kindly to it. And in the same breath, there was a guaranteed notes off-listed, $260 million, that was supposed to have made payment yesterday by Evergrande, failed. There may be a 5-day sort of grace period on that, which we're going to have to kind of shake out and see where that one goes. But that could trigger cross defaults, which in lieu will affect the dollar bondholders for all of Evergrande. Again, you know, where do we stand here? It's anyone's guess, because certainly Beijing has made no effort whatsoever to step in and bail out the company. And so, you know, we continue to see missed wealth payments, wealth management product payments, and quite frankly, missed creditor payments as well. And so that's where we are here this morning.
They're ring fencing it. You've got to wonder what is going on in terms of the strategy that's going to be applied here by the dollar bondholders. Damian, thank you very much indeed. Damian Sassower, Bloomberg Intelligence. Let's turn to Alex's favourite subjects. Oil hitting highs not seen in 7 years. This after OPEC and its allies stuck to production plans in their latest meeting. Joining us now, Julian Lee, oil strategist at Bloomberg News. Julian, OPEC appear to be in control of this situation. Is there any pressure for them to do more? Any pressure coming out of D.C., or are they comfortable with where they are now?
Well, the word we're getting out of D.C., or certainly the word we got before this meeting started, was that they were comfortable with what OPEC was planning to do, and indeed what OPEC has now decided to do. And that's to increase output by just 400,000 barrels a day in November. The fact that Brent is now up 3.2% on the day, WTI up over 2.5%, I think that may start to give people pause for thought as to whether this really is enough. I argued at the weekend that it isn't, that they needed to do more. They've decided not to, and prices are reacting.
Yeah, Julian, I wonder if they start to move kind of in between meetings now, potentially. Julian, thank you very much. Bloomberg's Julian Lee joining us there. I do want to point out some breaking headlines. The EU the EU drug regulator is approving a Pfizer and Moderna booster shot. The Pfizer one's been approved here in the U.S., but not yet Moderna. Yeah,
it's interesting that we are ahead in some ways. I say we, the EMA is ahead in backing the Moderna shot, because as we've been discussing, and you've got to wonder how people in the States who have had Moderna, who are wondering whether or not they can mix and match, are feeling about this. We still don't. We're waiting for two things, one of which is Moderna approval in the States, and also the data on mixing and matching. Because if you can mix and match, then it becomes less of a factor.
So my whole family got Moderna, except for me. I had gotten Pfizer, and they're just kind of waiting. Like my mom in particular, she's like, okay, let's go. Like, I'm gonna get it. We know it's coming, but can we like speed this process up along a little bit, particularly as we head into winter? All right. Well, coming up, you got Julie Beal, Kane Anderson, Redneck Portfolio Manager, will be joining us on her market outlook on this mushy Monday. This is Bloomberg. You like that?
We're heading towards a stagflationary scenario.
Inflation is a global issue.
But I call them stagflationary wins because they need not result in a stagflationary trap if you get the policy adjustment.
Inflation for us, I think, is here to stay.
Inflation is hot at the core level.
We're now sort of back to the levels of inflation expectations that we saw before the Great Recession.
Labor inflation is clearly an increasing problem.
If there is a persistence of inflation, how much will it eat into consumer spending? Will it eat into the growth prospects and the trajectory for next year? And that, I think, is the key risk.
I don't think this is a stagflationary scenario. I think this is a scenario where people might, in fact, at some point start pulling forward their purchases in anticipation of future price increases. And that's when it becomes a problem for the Fed.
That was from our Bloomberg guest commenting on the stagflation, inflation narrative in the market. Guy, anecdotally, I was in the Berkshires this weekend, and we have a neighbor who is the head chef in a restaurant. And he was saying that they had to close 2 days. They didn't have the staff. The servers and busboys are getting offered signing bonuses at other restaurants. And they have to rejigger their menu every single day because of price increases. He's like, the price of bacon is up 70%. How do you upsell bacon in a restaurant?
I don't think you have to. I had to queue again for fuel this weekend. I guess it's just becoming part of the narrative, isn't it? Shortages are becoming... I think the US and the UK feel like they're on the same page on this. There are shortages, I think, kind of material shortages, but I think unlike the EU, I think the US and the UK are in particular suffering as well from labour shortages.
Yeah, for different reasons maybe, but the same problem.
Yeah, okay, yeah, but different reasons, but roughly the same sort of outcome. And it's going to be interesting to see ultimately whether people do come back into the labour market and that supply side shortage gets closed. But there's a skills gap as well. So all of these things, I think it feels less and less transitory, I guess would be my take on what is happening here. So how do you position the portfolio if you're worried about this for a more inflationary environment? Let's ask that question now to Julie Beal, Kane Anderson Rudnick, portfolio manager. Julie, what are your thoughts on that?
You know, I think you don't know what the outcome is going to be. It's very hard to know if it's going to be transitory. And so your best bet is to find businesses that have solid pricing power, because that usually also tells you that it's a quality business that has a distinct business that people are willing to pay up for. So those are the types of businesses we're looking for right now.
So what are they? How do you find them?
A good business I would point to is Old Dominion, and this also plays into the supply shortages that I think are going to be here for a long time. Old Dominion has a completely differentiated business model in that their service levels are so high that customers are willing to pay a premium for them, and they've really invested in their network so that they can really leverage that business. So they've been well ahead of the game. They've been pricing, you know, in excess of higher fuel surcharges for decades, really. So they've really demonstrated that they have a strong business model that can weather volatile circumstances like this.
Do you need to look at businesses that are automating? Increasingly, this is a conversation we're having with more and more companies. Here in the UK, it's fruit picking. Vineyards are trying to figure out how they can automate to pick grapes. Warehouses, we were just hearing from Mark Manduka, looking to automate as well, trying to take some of that labour inflation out of the system.
Yeah, I mean, I think it's across all sectors of the economy. You have instances where people are there, you know, there are machines that do burger flipping, right? Because labor is super painful in the restaurant sector. That's one of the most painful points. It's a really high cost area. And it's one of the areas that's undergoing the most wage inflation right now in the US. So I think for sure, a lot of businesses are going to be looking towards automation. And I'm disappointed that it's not a bigger part of the narrative in the US economy for what is the potential for job losses as a result of automation.
For the index as a whole, particularly going to earnings season, there is questions now about how much of that is priced into earnings estimates. David Kostner over at Goldman Sachs says he thinks a key risk that supply chain normalization takes longer than expected, and that unmet demand today is not fully recouped later in the quarter. It's like we're not going to get that kind of juice later, and then we're going to get really hurt then in 2022. How do you think about it?
Yeah, I agree with that. I think that last year, if you look at last year, right, was we were going into the holiday season, people had the benefit of stimulus checks, schools were closed, and people wanted to get out and spend for the holiday season. And this year, we don't have the same level of stimulus support. Schools are really unsure if they're going to stay open or stay closed. You have all this noise from inflation. So I think it's actually going to be a pretty challenging environment for the rest of the year and going into 2022. I agree. I think the supply shortages are going to take time because, if there's an outbreak of COVID, the factory shuts down. In China, they're dealing with so many problems with getting enough energy, frankly, to run the factories. And so that's going to persist all the way down the chain.
Okay, so let's talk about what we do in our portfolios. You suggested focusing on key companies, i.e. I need to get active. Julie, I've heard time and time again throughout my career, now is the moment for active management. It hasn't been. Why is now different?
I think, if you look at how the market has reacted through this year, it really was the rising tide that lifted all boats, or in this case, stocks. It was just pretty indiscriminate, everything that rose up. And I think it kind of reminds me of, those first 2 weeks when you get to college and everyone kind of looks attractive. But if you think about it, you kind of noodle on it and you realize actually a lot of these people need therapy. And there's only really a few attractive candidates. So going forward, I see a lot of potential for strongly positioned companies to do well, but a lot of companies are going to have a very hard time managing through wage inflation, supply shortages, rising interest rates. It's actually quite a big order for companies to run through such an uncertain environment. And so I really do think the cream will rise to the top, and that plays into the hands of active managers who are willing to do fundamental analysis rather than fixating on the dot plot.
That is the single best analogy for buying the S&P that I've ever heard. Julie, does that mean that you want to sell tech, buy energy? I mean, I think it feels like that's now the trend in the last few days.
I mean, for me, no. We typically don't love energy, right? Because it's a commodity. It's hard to get real differentiation in that business. What's important is to factor in what higher commodity prices mean for your businesses. And I think that's how we think of investing because our time horizon is so long. And so focusing on businesses that can do well, typically software, is a business that has high recurring revenue. It's exposed to certain business sector trends like digitization. So we tend to like software over energy for sure.
Julie, great stuff. Great analogy. Thank you very much indeed. Julie Beal of Kane Anderson Rudnick. Greatly appreciated. Thank you very much indeed. Alex, we need to say goodbye to an old friend.
Yeah, we'd like to take a moment to mourn the death of Citigroup's longtime chief U.S. equity strategist Tobias Levkovich. He died on Friday. That was a month after he was injured in a car accident. Levkovich was a frequent guest here on Bloomberg, and his market predictions and commentary were widely followed. We will miss his energy and intelligence. Tobias Levkovich was 60.
It's time for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. I'm Ed Ludlow. One of the world's largest generic drug makers, Teva Pharmaceutical, has made a massive drug recall. The company is recalling more than 2.5 million vials of drugs made in the US. Teva says the drugs may not be sterile. JP Morgan Chase CEO Jamie Dimon is defending his pay again. Dimon told Axios' HBO program the bank's board decides what he makes. The board awarded Dimon more than $31 million last year. He said the CEO's compensation is part of a broader umbrella designed to retain senior management. Captain Kirk from the 60s TV series Star Trek is actually going into space. Blue Origin says actor William Shatner will fly on board New Shepard NS-18, which is scheduled to launch October 12th. The flight follows Blue Origin's first successful human flight in July, which included company founder Jeff Bezos. Shatner is 90 and will be the oldest person ever to fly in space. And that's your business flash. Guy.
Ed, thank you very much indeed. I'm trying to think of some great Star Trek quotes. Engage. I can't. There's got to be a few others.
It doesn't matter. It's awesome. That is brilliant. What an amazing PR stunt by Blue Origin. Like, everyone's going to want to turn into that. Like, Shatner's going into space. Like, full stop. It's dumb and it's brilliant all at the same time.
It is fantastic. I just hope it all goes well, because it is, as you say, going to be one of those fantastic milestones. I guess the pivot to Tesla is a fairly easy one from there. Tesla over the weekend, Alex, delivering a record 241,000 cars in Q3. That beat the street's estimates. This despite, of course, all the supply chain issues that the industry is facing, including, of course, those issues with computer chips. Stocks editor Dave Wilson is here, looking at what is happening in the sector right now. But Tesla is certainly having a good day today.
Absolutely, and it's a piece of a bigger puzzle. I mean, you look at those shipments, they were up 20% from the second quarter. So you're talking about the fifth straight quarter of what you would call sequential increases in production and deliveries. So, you know, that's definitely a plus. The latest figure about 8% higher than analyst average estimate in the Bloomberg survey, and also above the forecast that Tesla itself gave to investors. So, you know, it shows you they're managing even as those issues with global chip supplies hurt their peers. And then, you know, you turn and look at the shares. I mean, they're at their highest price since February, trading for around $800. They were at a record in January at just above $900. So now you're getting to the point where people are just not betting against Tesla the way they did. We have numbers out of IHS Markit from last week that showed you were just a bit over 1% of the stock available for trading in Tesla that had been borrowed and sold or sold short. And that's the lowest percentage, according to their data, since Tesla went public back in 2010. So even though the shares aren't back to their high, people are definitely backing away from betting against this company. And, you know, there are a whole lot of things going on in the auto industry right now. You have that electric vehicle maker Rivian filing to go public. I mean, they've got to deal with Amazon, 100,000 trucks by 2030 they can take orders for, and Amazon's an investor in Rivian as well. You think about what's going on with General Motors, their self-driving vehicle unit, Cruise. We're reporting, based on people familiar with the matter, that they expect a robotaxi business to be able to get to $50 billion in revenue. And if that isn't enough, New York Times saying activist firm Engine No. 1 taking a stake. And then you've got Veoneer, the auto parts maker Qualcomm, stepping in along with SSW Partners to make a deal there.
Yeah, Dave, we only have about 20, 30 seconds, but Volvo also now, maybe IPOing?
Oh, absolutely. And they've been owned by China's Zhejiang Geely. So the same company owns Geely Automobile. We're talking about potential $2.9 billion share sale. You know, it's coming at a time when sales are going up 40% plus in the U.S. and globally in the first half relative to the year before. And they're trying to become like Tesla. They want to be fully electric and be able to sell directly to consumers. So they're transforming their business, and they're hoping to go public to help do that.
Yeah. All right, Dave, good stuff. Thanks a lot. Bloomberg's Dave Wilson joining us there. All right, coming up, oil prices hitting their highest level since 2014 after OPEC Plus maintains its gradual monthly oil production increase. It's a bullish outlook. We'll talk to Goldman Sachs. This is Bloomberg.
The recovery will continue. It may be slow, it may be bumpy, but we are on the path of this positive trajectory.
Demand for jet fuel is going to pick up. At the same time, we're going into winter and we don't have enough gas to keep the world warm, and that's going to lead to a surge in demand. So it could potentially happen sooner, the $100 oil.
We still have a long way to go, but next year is probably going to be a lot stronger for travel, a lot stronger for oil demand.
All the risk is shifted to the upside, so we stick to our $80 target with potential risk by maybe even $10 higher than that, depending on what kind of winter weather we get.
Generally, in the oil business, when prices are so high, people begin to invest more, and then you create a new cycle.
That's a few of our Bloomberg guests talking about where they see the oil price going. How much more upside is there? You have oil prices at a seven-year high after OPEC Plus stands by only releasing 400,000 barrels of oil a day into the market. Damian Kervelin, Goldman Sachs head of energy research, joins us now. Damian, we had Jeff Curry on. He intimated you could see 90. At what point do you want to re-rate your base case to something like 90?
So our base case is actually now $90 for the end of this year for Brent. What we've seen just the last couple months point to a market entrenched in a large deficit. The Delta wave was a smaller hit to oil demand, and now the gas situation is actually creating upside risk to oil demand, and Iran negotiations are not going anywhere. So we are heading for a period of low inventories. You mentioned prices are their highest in 7 years, while inventories are about to fall to their lowest in 10 years. And in our view, that requires another leg higher. So, the OPEC meeting just completed, and for us, very much sets the stage for another meaningful leg higher here.
When is OPEC going to come under pressure from Washington, D.C. to do more? Gas prices are rising, and I'm talking about at the forecourt. The U.S. consumer is going to feel that fairly quickly.
So, the White House apparently was in contact, but didn't stress for OPEC to ramp up output at this meeting. There are maybe a couple of reasons for that. First of all, the acute shortage today is in gas, natural gas, not gasoline. So that's probably the most pressing issue. Second, adjusted for the overall level of income, gasoline prices are not as expensive as they were over the past decade at times. And third, OPEC is gradually ramping up. I think the pressure probably to do more will intensify if our forecasts prove right and oil prices are trading at $90 and with upside risk. So, I think that's something that could still play out. But as you think about the market for the next 6 months, this deficit, which is already the longest on record in the oil market, will persist. And even if OPEC did a lot more, that's at the mercy of its spare capacity. So this is just an outright bullish outcome. We just need more investment in oil production here.
So before we get to the supply response, just one more on the demand. Saudi Aramco in that OPEC meeting said that the spike in gas prices has increased demand for oil by about 500,000 barrels of oil a day. That's a lot of gas to oil switching. It's not that easy in every refiner, et cetera, or every pipeline. What has your models noticed in terms of what that switching actually is?
Our estimate actually isn't far. We're at 650,000 barrels per day. Now, keep in mind, right, we have a high stock of power plants that could run off oil. That was one of the incumbent fuels just 20 years ago. So that switching can happen, and we see it every winter. Towards the end of winter, when you're running out of gas, you will see those spikes in oil burn. So, are we seeing it now? Yeah, if you look at, Pakistan, Bangladesh, even Singapore fuel oil inventories, that's definitely pointing to substitution. Europe has less ability to do so, but on a global basis, we could easily do at times maybe 1 to even 2 million barrels per day during a very cold wave. The one main issue for the gas market, that's not sustainable. What I mean by that, those power plants are peakers. They ramp up for a few days and turn off again. And so that won't allow oil to really solve the gas shortage, although from an oil market perspective, it suddenly becomes an upside risk to demand.
Damien, you talk about Europe not having the ability to make that switch so easily. At the moment, there's scarcity in Europe, prices are high. What about actual shortages? Is that where we're heading? How cold does it need to get for that to happen?
It's a real risk, right? Keep in mind, we're in October. Winter hasn't started, and we have the lowest level of gas inventories. And so when you run normal weather distribution, you end up with decent share of outcomes where you truly hit shortages by February, March. So that's what the market is solving for. Again, no blackouts needed now, but you still have to resolve this underinvestment and lack of supply. So what's happening? Well, we mentioned gas to oil substitution. We're through that price threshold. The second step now is you're pushing some industries in Europe, manufacturing, fertilizers, at the margin on a global competitiveness perspective, which would reduce their consumption of gas. That's where prices are. Now, if it's a mild winter, we're okay. But again, you take a 1 standard deviation colder winter, and we truly have a problem. So nothing is resolved yet for Europe. And I think that's the key to keep in mind here.
So when you talk about your base case being 90 now, what is your upside risk? Are we talking 100? Are we talking over?
So keep in mind, in oil, unlike gas, we still have that spare capacity. Now, the real bullish outcome for any commodity market is your short-term shortages, right? If you don't have the supply, as we're seeing in China now, you have to destroy demand. That's blackouts. Now, in oil, we're not there yet, right? And again, I think of the energy complex, it's the lagger, but we're getting closer. And it's easy to envision, whether it's diesel, for example, fuel oil, where you're really boosting demand now to have those shortages. And then, yes, 100 is conceivable, above $100 conceivable. OPEC does respond, right? They don't want this economic shortage from an oil perspective, reducing economic growth. But, as we just learned today, it's not going to be immediate. And even when they decide, it's at least a month to play out. So I think that's the real risk that we see. Again, gas much more explosive. We're at that critical juncture. Oil could head there.
Damien, I've heard Energy CEO, and I'm talking about the shale patch here, after Energy CEO, telling me that they are going to be disciplined. They're not going to bring extra capacity back on. They're here for the shareholders. They're not here to pump more and more and more. At 90, at 100, at 110, how disciplined do you think they're going to be?
That's a key question, and that's actually what we solve for, right? When we argue oil prices have to be higher, it's because we need that investment to come back. Now, we've tested $70 for 6 months, and clearly that's not sufficient. You know, the activity of public producers, the one that really matter, really hasn't picked up much. So we think that's an 80-85 range that finally gets them to ramp up. But at the end of the day, they're no longer solving for an oil volume and an oil price. They're increasingly solving for their share price. So as long as E&P stock prices are not materially participating to this energy rally, they are not getting the signal to ramp up. So that's probably what to look for instead of the oil price alone, is really how investors are willing to see producers ramp up. And I would say today we don't have that signal at all. Now, what will compound the bullish nature of the energy crisis is really the cost inflation, right? When those shale producers come back to ramp up, well, service companies will be fewer and will have a lot more pricing power. So what could be critical to shale is really that step higher in costs in coming years.
Yeah, we're seeing it from labor to materials. As you say, it's going to be a huge factor. Damien, great stuff. Thank you very much indeed for the analysis. We really appreciate it. Damien Corvalin joining us from Goldman Sachs. Oil up, equities down. The S&P is now down by 1.33%. It's a fairly sharp rate of descent at the moment, Alex, on reasonably good volume. You do need to take a little step back. Over the last 3 months, the S&P is only down at this point by 1.27%. If you're a euro investor, it's actually higher. But the NASDAQ is the center of attention.
Yeah, the Nasdaq 100 down now by 2.3%, really dropping like a stone. There didn't seem to be that much in the factory orders, for example, or the durable goods that could have led to some more dramatic sell-off. So idiosyncratically, to take a look at some of these stocks, you have Moderna down for a second day now at the lowest level since July. That's you had Merck on Friday came out with good trials for therapeutic to help treat COVID, taking a little bit more pressure now on the vaccine makers. Also, Facebook now the lowest level since June. You got a whistleblower speaking in Congress, so that actually leading to a lot of heavy selling pressure on Facebook as well. My question, Guy, do the retail guys come in? Do they come in the same strength as they have before?
Well, I think we're going to have to wait and see. It's going to be a big, busy week. Obviously, it's going to end with payrolls. I think that could have an interesting impact in terms of people's perception of where we are with the Fed, the labour supply shortage story front and centre right now. But there do seem to be a series of slightly sort of idiosyncratic stories in here. Facebook, obviously, is one that we draw our attention to. But higher energy prices, this kind of narrative around shortages and higher costs, just feeding this narrative around the fact that maybe actually central banks will need to step in at some point. That will affect long duration assets like the tech sector, which then feeds us down back to that move that you're referencing, 2.24% on the downside for the NASDAQ. What are we going to talk about next? We're going to talk about trade. Little thaw in trade relations between the US and China, Alex. Amy Felico, Albright Stonebridge Principals, joining us next to talk about this relationship. This is Bloomberg.
This is Bloomberg Markets. I'm Ed Ludlow. You're looking at a live shot of the principal room. Coming up, Tiffany Wilding, PIMCO Chief US Economist. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ed Ludlow. The US is moving closer to its first ever default. Neither political party in Washington has signaled that it's ready to back down from a partisan showdown on the federal debt limit. Senate Democratic leader Chuck Schumer plans another vote as early as today on a plan to suspend the debt ceiling until December 2022. But Republicans are promising to block the attempt for a third time. It's an unprecedented leak of financial records known as the Pandora Papers, and it's revealed the offshore assets of dozens of current and former world leaders. A group of investigative journalists obtained almost 12 million confidential documents from legal and financial services firms. Among the highlights, the papers detail how Jordan's King Abdullah II secretly purchased 14 luxury homes worth $106 million. And in Japan, Parliament has appointed Fumio Kishida as Prime Minister. Kishida will try to revive support for his ruling party ahead of an election that could take place at the end of this month. Kishida has pledged to name younger lawmakers to his cabinet. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ed Ludlow. This is Bloomberg. Guy.
Ed, thanks very much indeed. The US trade deal with China not going as well as the past administration had hoped that it would. China is falling far short on December's targets of $400 billion worth of imports from the United States, a problem that the USTR, the US Trade Representative Catherine Tai, acknowledges.
Our analysis indicates that while commitments in certain areas have been met, that certain business interests have seen benefits, there have also been shortfalls in others.
Joining us now, Amy Selico, Albright Stonebridge Group Principal and Head of the China practice. Amy, let's talk a little bit about kind of what we learned today. Thank you for tearing yourself away from the speech that the trade representative is giving right now. What did Catherine Tai say today that stood out? This doesn't feel like it's a sort of bombshell moment that we're going to sort of change radically our policy. How, therefore, are things going to evolve from here?
Yes, Guy, I agree. No bombshell coming out of Ambassador Tai's remarks that are still ongoing right now here in Washington, D.C. What she said really were four things in today's speech. One, I'm going to start to re-engage with China directly on the Phase 1 trade agreement, because there are areas where we need to see if China is going to fully implement the commitments that it made a year and a half ago. Two, I'm going to restart a tariff exclusion process. Very good news for the business community here in the United States, who continue to be opposed to the Biden administration maintaining all of those tariffs that the Trump administration put into place. And then 3 and 4, Ambassador Tai saying that we need to have frank discussions with China about the trade relationship, but that trade relationship needs to start from home and being more competitive here. And so Ambassador Tai reinforcing that the U.S. in the Biden administration is going to continue to work with partners and allies in order to come to these trade discussions from a position of strength.
Amy, is any of that going to be effective? And I ask that because if you take a look at what China pledged to buy from the U.S., $200 billion in U.S. ags, energy, manufactured products over this 2017 level in 2 years. They're nowhere near close to that. As we can see right now, there's just no real enforcement mechanism because anything the U.S. does will have blowback. I mean, particularly as we're so dependent on ships, containers, freights, et cetera, from China.
Yes, Alex, I think when the Phase 1 trade agreement was announced, that $200 billion increase in products sold to China over 2017 levels within 2 years seemed overly ambitious at the time. So it shouldn't come as a shock that China hasn't met those commitments. And of course, in the ensuing year and a half, we had the COVID pandemic to deal with as well. And so I think that Ambassador Tai is saying she wants to engage with the Chinese, put their feet to the fire, to start buying more from the United States, but also have a broader conversation that the U.S. isn't trying to inflame trade tensions. What the U.S. wants is a fair trading relationship and fair rules for American workers so that China doesn't continue to undermine the global economy through some of its state-led industrial policy practices. That's hard. That's going to be difficult. Ambassador Tai this morning said she is not going to start Phase 2 negotiations with the Chinese. I think she's trying to keep this tight and realistic in what we can actually achieve with China. But I do think what she's signaling is we don't want trade to be the #1 point of tension between the United States and China. We have many areas of disagreement with China, and we have to engage so that we can make progress.
Amy, does the resolution of the, for want of a better word, hostage crisis surrounding Huawei and the prisoner swap that we've effectively seen over the last few weeks change the narrative? China was deeply, deeply distressed by that. And I'm wondering, with that resolved, whether it's going to be easier actually for other areas, because China likes to link these things together, to fall into place.
Well, I will say on the positive side that resolving that issue has removed a major source of tension between the United States and China, between China and Canada as well. And so I agree with you, Guy. On the one hand, without that issue plaguing the overall relationship, there's some room for progress. However, I think what we saw from that hostage crisis resolution is that there can be more risk for foreign companies, for foreign investors who travel to China as a result of concern over unlawful detention. So on the one hand, of course, there's positive there. We're removing that major area of risk. On the other hand, there's longstanding risk that's been created by that practice of politicizing those issues.
Amy, I'm wondering, for an investor and or a company, is China still representing the same kind of opportunity as we might have thought 10 years ago? And in that, I'm also wrapping in Evergrande as well, where these foreign investors still have not received a payment. Some are buying the dollar-denominated bonds on bargain hunting, some are not. And I'm wondering, like, if you didn't know anything about China, what do you do?
Yeah, speaking of risk, certainly so many of these issues do highlight risk for foreign investors to be in the China market, operating in China, and investing in China. However, the second largest economy in the world, an economy that is trying to rebalance the way that it grows by focusing on domestic consumption, means there are huge opportunities for foreign investors in the China market. And so, while there is more risk, just like 10 years ago, China is even more important to your global portfolio than it was in the past, I think.
Right. All right, Amy, thanks a lot. We'll let you get back there to the conversation. Amy Selico, Albright Stonebridge, thank you very much. Hey, some breaking news for you. A bid coming into the Treasury market a bit. So yields are still higher, but just about 1 basis point versus the 4 that we saw earlier. Dollar is still dropping like a stone. S&P, Dow, NASDAQ, all around the lows this session. In the S&P, Moderna, Twitter, Facebook, NVIDIA, all of those the worst performing stocks. And it's really energy that's the outperformer only, really, within the S&P. This is Bloomberg.
12 weeks of paid family leave.
6 days.
6 whole days of paid.
Well, unpaid.
Unpaid 6 whole days.
Nights.
6 nights of unpaid family half leave. It's not a bad compromise, right? And what do you want in return?
What about a child tax credit?
Great idea. Always said children shouldn't pay taxes. It's a lot of math.
But if we give children too much leeway, how are they going to get them to work in the mines, you know? We need their tiny hands to dig. All the big pieces of coal are gone. We need the little kid fingers to gather the little pieces.
Okay, then let's get real basic. Roads. Everyone okay with roads?
I like roads. Me too. Roads are where trucks live.
That was the cold open to SNL over the weekend. It was the premiere. They got a new President Biden in there. But the real joke was between Senator Manchin and Senator Sinema, how they're, in essence, really holding hostage the human infrastructure bill at a lower price and just making fun of the demands, even though they're considered Democrats, of how maybe off-center they may be to the right.
Well, yeah, no, but are they still to the left of centre?
No.
Is a question. Yeah,
well, the
and
House
that is the problem.
but not the senators, I think, and that's like the tension.
And that, well, yeah, exactly. But it depends where the centre is, I guess. And the funny thing is, you pointed this out to me this morning. I watched it, and what really struck me is this is the Democrat Party. These are Democrats in theory, all of them. And it's just so peculiar that you have this huge debate just to the left.
Yeah.
I forget the right getting involved at this point. You wonder when the Republicans are going to step in and almost kind of like, when it comes to the debt ceiling, at least save the day. And it's going to be fascinating.
They don't need to. They can just
happens.
watch the Democrats torpedo themselves. I mean, and I think that the narrative was that the progressives were going to hold the infrastructure bill hostage. And it seems like that's shifted now to these centrists, if you could still call them that, Senator Democrats, Sinema and Manchin. And now they're really leading the charge here. And the skit went on, too, because it made fun of them as in, like, Kristen Sinema, what do you want? And she, like, couldn't say it. Like, she had nothing to offer. She's just, like, against everything that they're for. And I just thought it really encompassed the dysfunction and the non-hilarity that we're seeing out of DC. Nice to poke fun at it, though. Totally. In a funny way. Yes. They did well. It was a good start. No, it made me chuckle. I watched it a couple of times. What are we going to do next? Talking of dysfunction, we're going to do the European close next. This is Bloomberg.